Let's talk about 5 habits that people have with good credit. Hi everyone, my name's Josh, the Florida Mortgage Dude. Welcome to June 2020. Holy cow, it has been a crazy year so far, and with this crazy year has come some overlaying guidelines. Some lenders have raised their minimum credit score requirements, so your credit score is more important now than it has ever been to qualify for a mortgage. I wanted to share with you the 5 habits that I've seen people have with excellent credit. Those habits are patience, they know their credit score, they are mindful of their debt to income ratio, they have different credit types, and they limit their credit inquiries. So let's start with the first one, patience. Patience is extremely important in today's society when it comes to improving your credit score. Any credit mistake will quickly drop your credit score. However, it takes time to rebuild and get your credit score back up. Creditors look at your credit history as well as the performance over that history to help determine what your credit score should be. So be patient. If you have had a hiccup in the past, be patient. Keep fighting the good fight. In a world of instant gratification, it really pays off, and it's really a feeling of accomplishment when you have the patience and obtain that higher credit score that you're seeking. Knowing your credit score. This is probably the most important one to me. Having a credit monitoring service where you can constantly check on your credit score, if it's gone up or down, what's positively or negatively affecting your credit score. Also, a lot of credit monitoring services have a feature where you can freeze your credit, so lenders cannot run your credit without your approval. So I highly suggest you keep track of your credit score through a credit monitoring service. It will pay off immensely on the back end with the tens of thousands, if not hundreds of thousands of dollars you would save in interest in the loans that you will get in the future. Being mindful of your debt to income ratio. Now, if you don't know your exact debt to income ratio, don't worry. You just need to be aware that you don't want to overextend yourself. You don't want to have too many loans out at once. Again, we're going to go back to patience. Being patient and paying off the liabilities that you have at hand, and then seeking out new liabilities when you need them. If you have a vehicle and you're close to paying it off, but your spouse or a somebody wants you to co-sign on another vehicle, be aware that maybe it's not the best decision to purchase that new vehicle until you pay off your own. Maybe, some families have multiple vehicles. Maybe it's not a good idea to carry 2 car loans, because those car loans can add up very quickly. So being mindful of your debt to income ratio is very, very important. Having different credit types. What do we mean by that? So there's 2 different credit types you can have. You can have an installment loan or revolving credit. An installment loan is anything with an amortization schedule where you make a principal and interest payment and you have a timeline on which the loan will be paid off. These are not credit cards. These are home loans, car loans, student loans, and then you have your revolving credit, which are your credit cards and lines of credit. Having a mix of these 2 types of credit will really help show that you can handle multiple types of financial responsibility. This probably goes without saying, but making those payments on time as agreed is vitally important to your success when it comes to achieving a high credit score. Now, having a hiccup there, here and there with a late payment is not going to be detrimental. It will hold you back. But taking advantage of auto pay, 9 times out of 10 companies have a feature where they will actually give you a lower interest rate in exchange for you to put that loan on auto pay. So they know that they're going to receive that money every month. So keep that in mind when you're moving forward. Credit inquiries. So this one is interesting. I always get asked, is this credit inquiry going to drop my credit score when people come into my office to get a mortgage? My question I always ask in response is, have you had any inquiries in the last 90 to 120 days? That's really what we're looking for. If somebody says, no, we have not had any inquiries, or we bought a car 4 months ago, if I run your credit, it will more than likely not have any impacts on your credit score. The challenge is when you apply for multiple types of loans within a small time frame and have multiple inquiries on those types of loans, and you start adding up your inquiries, that is a red flag to lenders that you may be putting yourself under financial strain. So to combat that, you should spread out your large purchases. Purchase the home first. A mortgage is the most difficult type of loan to apply for and get. So get the home first. Get the car later. Wait a couple of months. The lenders want to see that you can handle the new financial responsibility. So don't just run out and buy a new car the day after you close on your home loan, or apply for a new credit card the day after you close on your home loan. So be mindful of your credit inquiries. If you have any questions about credit scores, about any of these habits, or about buying or refinancing your home, please reach out. Have a great day.